Welcome to our Plan Giving webinar to 2020. My name is Adele Goldberg. I'm the Executive Director here at Friends of Yad Sarah, and we are delighted to have our specialist on hand to talk about some of the tax strategies that you can take for charitable giving. Neal Myerberg has been working with us for more than 5 years. He's a well-known authority on tax and financial planning strategies. He's an attorney, and he provides consulting services for charitable organizations and philanthropists on estate and tax income planning issues using charitable plan giving vehicles. He teaches in the master's degree plan giving course at Columbia University and has been a frequent speaker at local and national plan giving conferences, as well as a resource to the New York Times, the Wall Street Journal, and Dateline NBC. For many years, he was a regular presenter for Consumer Reports magazine at programs throughout the country on tax and financial planning strategies using charitable giving techniques. So I want to thank Neal for joining us today. I just want to give you a little housekeeping before I turn the program over. If you have questions, Neal's going to launch right into the presentation. And if you have questions, there is a Q&A button on your Zoom screen. You can use that. And I will be breaking into his presentation from time to time to present the questions. There certainly will be plenty of time at the end for questions, but feel free to speak up virtually if you have any questions in the middle of the program. And without further ado, take it away, Neal.
I'll try to share the screen here for everybody. All right, hopefully everybody can see it. Good afternoon, everyone, and happy to see you. I hope everybody is doing well and staying safe. And you can see by the topic of this presentation, I'm going to speak to the extent that I have any information about what challenges we're going to see as a result of the new administration and the tax ideas and tax proposals that have been advanced during the campaign that may take effect in 2021, and they're going to have significant consequence to many of us for the greater good, I suspect, but also it's going to result in taxation changes that we've been accustomed to for the past several years. So the title, New Tax and Financial Planning Challenges After the Presidential Election, takes me to a discussion about what the campaign discussed in terms of the Internal Revenue Code. Now, President-elect Biden campaigned on a series of major changes to tax code, and the changes were both income tax changes and estate tax changes and gift tax changes. Consequentially, of course, there'll be changes to how individuals of various income levels will be taxed, how estate at various levels will be taxed. And as you can see in bullet point number 2 here, proposal is also going to discuss how wealthy, and this word is a very relative term, families will transfer assets to heirs and whether there'll be costs involved, costs that aren't in place now as of this year, 2020. Income tax changes. Now there's going to be rate changes. It may not extend to many of us on this call, but we ought to know about it. The current high level of 37%, the max rate will go up under the proposal of 39.6. The rate for corporations is going to be expected to go up. Whether the rates go up for people at different thresholds below the highest is still to be discussed. And for those people who have earnings over $400,000, there'll be a substantial increase in the amount one has to contribute in Social Security tax. Now it's only up to $137.7 in wages, but they're going to assess the tax even higher for people at this level. So that way there'll be more money in the Social Security system, which is good for all, but it's going to result in a tax consequence to people above this threshold. This is interesting because this is going to lead to discussion about estate planning. The call is going to be to raise the capital gain rate. Capital gains rate for even the wealthiest is 20% for long-term capital gains presently. There's been discussion now whether to raise that rate to 39.6% for individuals who have income over $1 million. Now, again, that's a select group of people, but not $10 million, $1 million, and the rates will grow almost double from what they are now to what the proposal is to raise more tax on the wealthy who make capital exchanges. So from an income tax point of view, the essential changes that we'll see or face will be changes in rates, changes in brackets, changes in the amount we have to give into the Social Security system, and changes in capital gain rates for certain people who reach certain economic thresholds. We also have to talk about wealth transfers, because this is where it's going to be maybe felt more by some families. Overhauling wealth transfers, which is estate taxes in a way, or gift taxes, is a cornerstone of changing the way we've been doing things for a number of years. If you check in bullet point 3, you'll see that as of this year, for people who die or make gifts in 2020, one has 11.58 million in credit, an exempt amount that can be used. And if you're spouses, you have that ×2. And
Neil,
yes,
we have a question. One of the participants would like to know if money will need to be taken from IRAs in 2021 for those in the mid-70s.
well, we haven't gotten to that point in the slide yet, and we will, but I will say to you that the rule for required minimum distributions is being able to avoid requirement distributions is going to end after 2020. That's what we all understand. And we're going to get to that in just a moment, but essentially this is your only free year for ability to not take RMDs. But in estate planning, this plus ×2 is what spouses have, which is almost $23 million in exempt amounts. And if we go to 2021 under current law, it goes from 11.58 to 11.7. So you have a lot of money available for transfers during lifetime or after lifetime. And there's portability, which means that if one spouse dies without using the whole amount up, whatever remains unused can be used by the surviving spouse in addition to his and her exempt amount. So pretty generous amounts for most people. There's discussion, though, that they're gonna change it back from these large numbers to a number like $3.5 million in transfers at death, or $1 million in lifetime gifts. And they're going to increase the maximum gift tax rate to at least 40%. Now, this is very consequential. This goes back to the law before the changes were made to increase the exempt amount. If we have a $3.5 million exempt amount, anything above that amount that is subject to estate taxes could be taxed as high as 40 or 45%. And I'm not even talking about what happens in various states that assess their own estate taxes. So this is something to ponder. Doesn't give us much time. The question becomes, if the changes are made in 2020 for 2021 and thereafter, and suppose sometime in 2021 or even 2020, we follow these guidelines, ultimately those changes, will they be able to reach back and say to you, even though you use the rules then, we've changed the rules, so therefore you've got to comply with the new rules. There's every indication based upon an IRS revenue ruling that there'll be no clawbacks. So those of you who say, well, we better make some transactions quickly to take advantage of these exempt amounts because it may drop this way, do it. They won't claw back to say, hey, you did it, but we've changed the rules. The rules will be as they were at the time. The thing to look about up here is important, and this is probably as consequential as anything. As many of you know, at the end of lifetime, if you have stocks, for example, highly appreciated stocks, or real estate, for example, that have substantial capital gain, at the end of your lifetime, if you pass it on to your heirs and you can exempt them from this amount of estate taxes, then they take the new assets subject to a basis that is the value at date of death. Under the new rules, there's a situation where they're describing that they will eliminate the step up in basis, which means if your stock is Apple and you bought it at $20 a share and it's worth $200 a share at the end of your lifetime, the $180 in growth would not be taxed under present rules. They would step up in basis. But under rules that are proposed, the $200 amount would not be the amount in the hands of your heirs. It would be the $20 amount in the hands of your heirs. And they would have a $180 gain per share that they have to pay tax on the stock was sold by them. It's very consequential. The step up in basis in estate planning has always been very important. Will it be eliminated? That's the conversation. Can I suggest to you that what I'm proposing for you today is what's going to happen? I cannot. except that those of us who watch it and those who write about it, and there's been a lot of literature in the past 90 days, think that this is something that may not happen in 2021, but will happen sometime along the road. Now, remind ourselves of this. Even if this is proposed by the administration, it's got to be approved by Congress. And whether or not the Congress will compromise, whether or not the Congress will go along with the administration is something that none of us can know, but we have to start thinking about and planning for it. So how do you plan in light of these changes? I mentioned on the first bullet point, you might want to take use of some of these unified credits. Now, particularly if you're going to make any lifetime gifts of any consequence, apply it to this exemption, because this exemption doesn't apply to estate taxes until the time of death. And so it's December. And so anything you do now is essentially going to be done based upon gift taxes, not avoiding estate taxes. It also might be helpful to accelerate some income before the end of 2020, because the rates in 2021 might be higher than 2020, particularly capital gain rates. So I'm mentioning in this bullet point, maybe a good idea to harvest some long-term capital gains before the end of 2020, so that the tax cost to you will be based upon the low amount, 20% or less, and not the higher amount that may come into effect in 2021. And also, this is kind of fundamental, to the extent you want to avoid all capital gains on highly appreciated long-term capital gain property, that which you gift to charity directly goes to charity at full value for your deduction purposes, and you pay no tax on the gain. So you can harvest some gains and sell and pay lower tax levels now than you may have to pay in 2021. And you can gift some away to charities, to foundations, whatever you might want to do, even to donor advised funds in 2020, and get rid of the capital gains on the donated stuff. There are two acts we need to talk about that have been around, and you probably heard them called the CARES Act and the Secure Act. And they're interesting because some of the provisions in those acts will continue on and some will not. For example, under the CARES Act, any of you who make gifts to charity but don't itemize, and you make gifts up to $300, can deduct that amount against your total income. It's like a below the line deduction from your income for $300, even if you don't itemize. Number two, under the CARE Act, you can make, and this is really interesting, what's going to happen with this. For the next couple of weeks, you can still make gifts of cash to charities up to the value of 100% of your adjusted gross income and deduct that full amount for 2020. It's important. We don't believe that this adjustment feature that gives you that much flexibility of deducting your charitable gifts if you itemize is going to be in effect in 2021. This is probably only a 2020 provision. In 2021, it's going to go back to 60% of AGI. So using this provision this year to accelerate your giving to charity, cash gifts only to charity, and taking advantage of the large deduction you're allowed, which is equal to 100% of AGI in 2020, could save you considerable taxes. And think about it this way. Those of you who are required to take minimum distributions from your qualified plans, who are not going to take those distributions in 2020 because you don't have to, will have less income to pay tax on in 2020. If you then take advantage of this deduction, 100% of AGI for charitable giving, even the smaller amount of income you have in 2020, you can almost zero out the tax. 2021, a different story. As asked earlier, will you have to start taking your RMD in 2021 if you're 70 and a half or 72, depending upon where you fit into the picture? The answer seems to be yes. In the Secure Act, there's something very important, and we're going to talk about it because it's complicated. Forever, as you may know, and I'll show you right here, you could have an inherited IRA pass on to your heirs, your children, your grandchildren, family member, spouses, still the rules will be the same, and they would take it subject to being taxed on a period of time based upon their life expectancy. So adult children who are in their 20s or 30s, they could take payments for a long period of time and soften the tax bite each year. That rule is changed as of 2021. Actually now, as of 2020, from the Secure Act, the rule about expanding the repayment back to based upon life expectancy is now reduced to 10 years. You can no longer stretch out the withdrawals. You have to take it out within 10 years, pay the full tax in 10 years, and then it's done, which is really difficult for those who have planned on leaving their IRA, for example, to a child or children, anticipating they would have income for their lifetimes at predictable rates and would pay soft taxes. That's not going to be the case anymore. And I'll show you in a moment what you can think about doing that. I want to back up for a second to remind you, and this is a slide that just simply shows the standard deduction for $300 this year. We think that this will be renewed for 2021. We think it will be. The itemized deduction rule for 100% of AGI, we don't think that's going to be renewed in 2021. It'll go back to 60% of AGI. And in 2020, if you take advantage of this provision and you make cash contributions to charity to take advantage of the deductions, you can create gift annuities or fund charitable remainder trusts and get income for life. And those cash contributions will still be eligible for deductions up to 100% of AGI if you itemize. This is more complicated. I need to speak a bit about this because I can't imagine there aren't people who have in fact planned their estates on the basis that their qualified plan money was going to go to the next generation, and the next generation would be taking it out over life expectancy and paying small amounts of taxes. In truth, now it brings out a charitable giving vehicle that's always been there but has not been necessary, and that is the charitable remainder trust. There's going to be some strategies coming up now about using that trust to solve the problem of the 10-year rule. What is a stretch withdrawal elimination? And are there exceptions to it? And that's important for you to know. The exceptions to it, those people who can still take it over life expectancy, a surviving spouse of the original owner, a surviving spouse, a minor child, not a grandchild of the original owner. In other words, somebody who's under 18. And once that person reaches 18, the 10-year rule applies. Not a grandchild. If there's a minor child in this scenario, parent dies early, minor child is the beneficiary of the IRA, minor child takes it for a number of years based upon a life expectancy, and the moment it turns 18, gets to the 10-year stretch. Number three, if the beneficiary, not a child, not a spouse, is less than 10 years younger than the original owner. So if the decedent is 70 and the person who's going to receive the payments from the IRA is 61, then that person can take it over a life expectancy because that person is less than 10 years younger than the original owner. And lastly, under special rules, beneficiaries who are disabled or chronically ill can avoid the 10-year stretch limitation. Very important to know this because it uproots so much of the kind of planning we were doing for estates for people, and there are many who have a substantial part of their estates tied up in 401ks, in IRAs, and things of that sort. This slide, and again, you don't have to read it all, I just want to say, if you have exceptions don't apply, you might consider a charitable remainder trust, which can run for the lifetimes of beneficiaries. So to make it simple, if you have a $500,000 or $1 million in IRA funds collectively, and you want to leave them for your children, and you don't want the 10-year rule to apply, which means it all gets out in 10 years, they can spend it all in 10 years, they can do it with things that you didn't want it planned for, and pay all the tax, which is substantial. You can create this charitable remainder trust at the end of your lifetime by document, by will or otherwise, and have it run for their lives, not just for 10 years, let it run for their lives. Or if they're older at that point, it can run for their lives or 20 years, whichever is the longer. They get payments every year at a fixed rate. The tax costs may be modified by what the nature of the investments are, and you have solved the 10-year problem. At the end of the term of the trust, whatever remains in the trust goes to the charity or charities you want to identify. But during the course of the trust, your heirs will be receiving income at a stated rate, either a fixed amount or an adjustable amount based upon the growth and value of the trust. At the end of the trust, no taxes. Charity receives, when the trust is created, no income taxes to the deceased, and a substantial tax deduction for estate tax charitable purposes.
Okay,
More,
Neil, there's a question before you move on.
yes.
If you do not take your required minimum distribution for 2020, are there any forms you must file with the IRS or with the holder of your IRA?
No, you don't have to file any forms. You just don't take the distributions. If you don't take the distributions, there will not be a 1099-R. The 1099-R is what the IRS sees with regard to that. It won't be filed with them because the administrator has not distributed anything to you. You have to do nothing else beside that. Okay, so let's look a little further down. Let's finish the conversation we just had about tax law changes. This is just an overview of what we know has been discussed in the campaigns, and we know there is some priority too. Whether estate tax exempt amounts will drop from $11.7 million or to $3 million, $3.5 million is, we don't know that, but we suspect it will be because, in fact, after 5 years to 2025, is going to go back to the old rules anyway. This is just a window of time between now and 2025, but they are thinking about making that window close sooner than 2025. So we have to be concerned about that from a estate planning point of view. Number two, need to take advantage of the provisions in the CARES Act. If you're thinking about trying to reduce your taxes considerably, particularly this year when you didn't have to take your RMD, so your income is lower, then those gifts to charity at 100% of AGI can be very valuable to you. Number three, be concerned about stocks and highly appreciated capital gain assets. If your plan is to leave them in your estate to your heirs, be really aware about whether the rule changes that doesn't allow them a step up in basis. And number four, in your estate planning, be alert to how you want to pass your IRA, your 401k after your lifetime, and whether or not you might want to choose some alternatives. This is going to be a good year for all of you to be speaking with your professional advisors. There's going to be a very difficult year for them because they're not going to really know much more than we're talking about now, but we'll all be watching this as time goes on. And I know that Friends of Yad Sarah from time to time will send out alerts to you about things that are uncovered so that you can read them, consider them, ask questions about them, and show them to your professional advisors. Now, one thing we know isn't going to change, and we're kind of convinced, is there will be no measurable increase in interest rates in 2021, maybe not even in 2022. We know that because if you can see down on the bullet point here, usually interest rates are raised because when economies get overheated and there's inflation, you raise interest rates to calm down inflation. But the Fed chairman stated in August, this past August, and has reiterated that the Fed doesn't feel obliged, won't feel obliged to raise interest rates, even if we get to a full employment economy and are able to show growth at numbers that we haven't seen for a while now. So therefore, there's a very strong possibility interest rates will stay quite low. And if that's the case, as you know, those of us who depend upon interest from CDs and money market accounts and savings accounts and bonds, anything that is safe and produces interest that we can use so we don't have to cut into capital, not much opportunity now. The only good thing about it is, I guess, that credit cards that adjust have lower interest rates on carrying balances. But by and large, interest rates are good for getting the economy rolling, but not great in terms of people depending upon yields on safe investments. As you can see here, when I did this calculation recently, rates for 4 weeks to 52 weeks of treasuries were 0.08% to 0.11%. So it's really very, very tiny. And you all know this because you see it every day. Most of us are being paid zero for money sitting in banks that banks are lending out. So it's not a great time to be a person depending upon fixed income. Secondly, because interest rates are so low, the IRS discount rate is very low. Never been lower, 0.4% to 0.6%, which is in December and January. These rates are the rates of growth that the IRS is attributing to assets in general, just nothing. And this affects calculations, including rates for annuities. Right now, for example, if you're under the age of 70, annuity rates are being adjusted back in order to qualify because the presumption of return is so low for charities that who receive that at the end of their lifetime of the individual. Also affects commercial annuities, annuities that aren't issued by charities. People don't want to take risks with cash to get more return. Buying junk bonds, buying high yield fixed income that is not rated, not given investment grade. One wants to take risks because one is sometimes desperate for more return, but it's not a great idea, particularly as you get older. And so here's the challenge. Why is it challenging now to secure a safe fixed income? Because the numbers issued from the Fed and in the economy are very low and will continue to be low. So what's the solution? Well, obviously find some place to get fixed income at a higher rate that's safe, which takes us to this. And many of you have done this already or have known about it and have considered it. It is a special kind of annuity issued by charities that have been qualified in state laws to issue them. New York is a highly regulated state. Yad Sarah and other charities are qualified to do this in New York. And when you do a gift annuity, you want to be certain the charity you do a gift annuity with meets the requirements of the highly regulated states like New York, California, New Jersey, Arizona, Washington, Maryland. There's a bunch of states that have high regulations, Florida being another one. You want to be certain that those states comply, and you want to be certain that the highest compliance point is based in New York. And so any state that you buy a gift annuity living in that is with a New York charity, the document will say New York rules apply. In this case, a gift of cash or securities to a charity allows you to receive fixed income for life, undoubtedly increases the yield you're getting from the cash now, get an income tax charitable deduction. When I say the word immediate income tax charitable deduction, I'm missing an adjective. Receive a substantial deduction and a substantial portion of tax-free payments. Right now, and you'll see this as the program progresses, the amount of tax-free income in charitable gift annuities for people across all the ages beginning at 65 is better than 80, 85, almost 90%. So your gift annuity amounts that you get, the payments, are going to be almost all tax-free. That's the basic fundamentals. And they can be immediate, which means you create the annuity at your age and payments begin measuring right away, or deferred. You're younger, or you want to wait for a while, you want to set an annuity up now and have a future rate that can be calculated now to give you more return when you reach a certain age. For example, you may be 60, you don't want to start till 70. Maybe 65, you'll start at 72 when you are then required to take your RMDs. So there's all kinds of scenarios. It has to be for one life or two lives, can't be for multiple lives. And it's got to be done with a charity that has the legal capacity, the legal authorization to be able to do it. Certain criteria, you probably know this, but let's review it. It's not how old you state you are, it's how old you are to your nearest birthday. And that's very important, because if you are within 6 months and 2 weeks of your next age, if you waited those 2 weeks to be within 6 months of your next age, you're then your next age for rate purposes, and your rate will be higher. So when we get requests, and Adele looks at this all the time, of someone who says, my date of birth is July 10, and we now are in December 20, we know that if we waited till January the 12th, we'll be within 6 months of July 10th. So we always say to individuals, we're grateful that you're interested in it. We're going to calculate it as if you do this on July the 12th, because that way you're your next age, you get a higher rate. Number two, it can be for 1 or 2 lives. Spouses, siblings, parent and adult child of some age, not just a 20-year-old. And when we do this calculations, you'll find, and I'll show you on the slide, that when you have 2 lives, the IRS presumes that the 2 of you will live longer than each of you individually. And as a consequence, 2 life rates are always lower than the 1 life rate for the younger annuitant, because the expectancy is that 2 together live longer than each individually. It's an actuarial phenomenon, and there's no way to rationalize it except that's what the belief is. You get the annuity, even if you outlive the life expectancy tables, continues to be paid at the fixed rate. And lastly, unlike outright gifts to charity of stocks that have grown in value, where you get a full deduction and you pay no tax on the gain, if you use stock, for example, to buy a gift annuity that has some capital gain, some of that capital gain, we calculated, is charged in each annual payment as part of your tax cost for the annual payment. It's like an installment sale, but only some of the gain, based on the part that's not a charitable contribution, is taxed in the gift annuity. So let's look for a second at some examples, and I think this will make more sense to you. And again, the reason I'm talking about charitable gift annuities, not general gift annuities, is because charitable gift annuities have certain rules that are really favorable to individuals, particularly individuals who don't mind that when the annuity is over at the end of their lifetime or lifetimes, that the so-called profit, I use that word in quotes, which would otherwise commercially go to an insurance company, is going to go instead to do the good work of Yad Sarah. So in this case, I've got a donor age 70, male or female, whose life expectancy under the tables is just about 16 years, who has a $10,000 CD coming due in the bank, who says, if I do a gift annuity Yad Sarah, give me some details. Calculate for me what result would be if I give you $10,000 for an annuity for my lifetime, age 70, knowing full well when it's over, whatever remains is going to go to you. It's called the residual. Now we do the calculation. We look at the tables, and we determine that a $10,000 gift annuity at age 70, that the rate will be 6.5%. And I should point out that every charity doesn't have the same tables of rates. So when you look at charitable gift annuities, you want to look at tables of rates, not that the table rate alone would make the decision for you, but it's something to think about. I would think that the most important thing is that the charity you do it with is a charity you believe in, but you also would want to know the rates. So in this case, the Yad Sarah rates for age 70 is 6.5%. $10,000 gift, $650 a year in payments, payable usually quarterly, semi-annually or annually. Sometimes people ask for it monthly. That can be done. Get a tax deduction. Why isn't the deduction $10,000? Why is the deduction only $1,221? Because charity doesn't receive this until at least 16 years thereafter, during the course of which they're paying out 6.5%. The IRS mathematics says your tax deduction is about 12% of your contribution, or $1,221. Itemized charitable deduction. If you're paying federal and state taxes combined at a marginal rate of 25%, and you deduct it, you'll save this much in income taxes, which reduces your cost. If your cost is reduced to $96.95, but you're getting $650 in payments, your effective return is 6.7%, and it takes me to line 8, which is a compelling line that I've never seen before in all the years I've been doing gift annuities, because the discount rate is so low. This person will receive this amount for perhaps this many years if he or she lives life expectancy, and nearly 85% of it will be paid each year tax-free. When a 1099-R is issued for this donor, it'll say receive $650 and rounded 15%, 15% taxable, 85% tax-free. Donor age 70, one life, example number 1. Let's say someone is 5 years older, just to see the changes. Donor age 75, life expectancy is shorter, older, shorter, 12.4 years. Says to Yad Sarah, I wish to see a calculation for a gift to you of $10,000 to buy an annuity for my lifetime. What is my rate? 7.1%. On the tables, rates are the same for every 75-year-old for Yad Sarah and every 65-year-old. The rates cannot vary. They're across the board based upon a person's age. $710 a year would be the payment. The tax deduction is larger than my 7-year-old example because life expectancy is shorter. Tax deduction is almost 25%. $24.55 is the itemized deduction. At this marginal rate, it'll save this much in income taxes. That income tax savings reduces the cost down to $93.86, which increases the effective rate because you're getting $710 on a net cost of $93.86. And look at this, the tax-free portion for life expectancy, 85.7%. Every dollar received, only 14.3% of it is taxable. Pretty compelling stuff. What's happening in these two examples? High rate, income tax deduction, tax savings from the deduction, substantial tax-free income, and when it's over, whatever remains in it goes to do the good work of Yad Serah in Israel. Example number 3, just so you see the difference. The same person, age 75, gives $10,000 in stocks instead, with a cost basis of $4,000. There's a $6,000 gain in this stock. Sorry. And so what happens is, much of the data is the same age, same life expectancy, same amount, same tax deduction, same rate. All those numbers exactly the same as the prior screen, until we get down to lines 8, 9, and 10. The large amount of tax-free income for the cash gift of the 75-year-old, which was 85.7%, is reduced because a portion of that, which would have otherwise been tax-free, is going to be taxed as capital gain instead, because some part of the $6,000 gain is considered to be part of the purchase, not part of the contribution gift, and therefore it's going to be taxable. So in the annual 1099-R, it'll say received $710, 14.3 normally taxable, 51.4 at cap gain rates, 34.3 at tax-free rates. So what's the difference between the two? Well, if you had a choice between giving appreciated securities and cash, you might choose to give cash to maximize your tax-free rate. But if you have highly appreciated stocks, you won't be taxed on the whole gain, and you won't be taxed at one time. You'll be taxed only on a part of the gain over life expectancy, like an installment, 12.4 years. Example number 3, using capital gain property. Now be mindful of this example as I go to example number 4. In this example, I've got a couple. Could be spouses, could be siblings, could be friends, ages 82 and 80. And they say to Yad Serah, we wish to create a charitable gift annuity for both our lives, combined, joint and survivor. What would the rate be if we do that? Now, I'll find this very interesting. The rate for donors 82 and 80 is the same rate as for one age 75. Life expectancy of 2 lives 82 and 80 is 12.1 years. Life expectancy of my 75-year-old, 12.4 years. Remember that slide I said where life expectancy of people together is longer than individual life expectancies? This shows that. So the reason it's 7.1 is because it's only 0.3 of a year difference in life expectancy from the individual 75 to the couple ages 82 and 80. So they get the same annual annuity amount, a little larger tax deduction than the 75-year-old because a little shorter life expectancy. Look at this though, their tax-free portion for the couple running through both their lives is almost identical to the tax-free portion of the 75-year-old individually. So when they receive their 1099-R jointly, and when the receiver receives his or hers, same amount payment, 87% is going to be tax-free. So you can see here, this number is extraordinarily unusual, and it's going to be there as long as the IRS discount rate is low. If the IRS discount rate starts rising in 2021 and goes from 0.6% to 2 or 3% over a period of time, it's going to affect this. It's going to make this lower for that gift annuity established then, and it's going to make this lower, the charitable deduction as well. To preempt the question, if you did this now and the discount rate went up or the rates changed in the tables or anything like that happens, would your gift annuity have to be adjusted because of that? And the answer is no. The contract you make is a contract that stays through the entire term of the annuity, even though rates may change for the next people of this age, and even rates may change to affect the amount of tax-free income. So to do it when times are opportune, and people have been doing it a great deal in 2020, is to take advantage of high rates, lots of tax-free income, substantial tax deduction, and put this away as a lifetime CD. It's what it is. It's a lifetime bond. Now, is it safe? Is it secure? Let's answer that question. Because it's being done with a New York charity, New York requires the charity to act like an insurance company, has to create a segregated gift annuity reserve account, held by a trustee. And in the case of Yad Sarah, it's held by PNC Bank, a national bank and trust company. It has to be based upon, and the reserve has to have money in it to be sufficient to pay all the annuities plus an annual surplus equal to 25% of the amount required to protect against any market corrections. And that has to be revisited every year by an actuary and reported to the state of New York so that New York can see that every year there have additions have been made to keep the reserve account sufficient. So whether you do it in New York or California or New Jersey or those regulated states, you want to know that that's going to protect your annuity. If you happen to be living in an unregulated state, say you lived in Michigan or Texas or Massachusetts, for example, if you do an annuity with a charity based in New York, even though you're in a state that's not regulated, you get the advantage of the regulations of the highly regulated state, which also involves a segregated reserve account, which means that you get the same protections as if you were living in New York. And lastly, what about a deferred gift annuity? Suppose you are 60 and you don't need it till 70, and your life expectancy at 60 takes you to be almost 86. If you give it now to Yad Sarah, can a rate be calculated to determine what you'll receive at age 70? And we can, as you can see here, we're taking this $10,000, giving it to Yad Sarah, doing the calculation to determine that the rate at retirement at 70 will be 8.2% at 70. Remember, if you were 70 to start off with, your rate would be 6.5. But if you defer it, your rate will be 8.2%. We know that. We can program that. You get a small tax deduction, about 10% of the value of the contribution now, which reduces the cost somewhat. And when you begin to receive the payments at age 70, when your life expectancy is then 15.9 years, 10 years later, 68.3% of it will be tax-free for your life beginning then. I want to point out to you one thing here, the word flexible. You can have in your contract for a deferred gift annuity a schedule of payments, we call it Schedule B, which says beginning at age 70 and for 15 years to age 85, exactly what your payment would be if you chose any one of those years to be your commencement date. So let's assume you know this is going to be your rate at age 70. You get close to age 70 and you decide to look at the schedule, Schedule B, and you say, you know something, I don't need the money at age 70. I like to start the money at age 78. You will know from that schedule exactly what that number will be from the beginning. So that if you choose age 78, you'll know exactly how much you're going to be paid. It's a very compelling thing to do for economic reasons and for philanthropic reasons. It's good to know that by doing this, you're getting the advantages that I've described to you, but you're also doing something for charity or charities that you believe in. You can do multiple gift annuities. There are people I know who do gift annuities every year, and each year their new gift annuity is going to have a higher rate than their prior one because they're a year older. So this is what we call gift annuity planning as a way of dealing with interest rates. I'm going to pause for a minute, Adele, and see if there's any questions you have.
No more questions right now, Neal.
Okay, let me go forward a few things. Remember my talk about the 10-year stretch and that we now have to limit our 401ks, our IRAs to 10 years for our heirs who receive them. I am not giving an example here of what a charitable remainder trust is in that scenario, but just to show you what it is in general. And the charitable remainder trust is usually used for highly appreciated stocks, property, not with cash. Because with a charitable remainder trust, if you fund it with highly appreciated stocks, in this example, stocks that are now worth $250,000 with a basis of 50, the $200,000 capital gain is not subject to tax when you make the gift. It's not a gift annuity. It's a separate trust. So you put this stock into the trust. We look at the IRS rules to see exactly what the rate could be for this person, not based on tables. It's based on the discount rate. And he or she would have a rate of 5.5%. The rule is it can't be any lower than 5, just qualifies. No tax on the gain, payments of $13,750 a year for the rest of her lifetime with a current income tax deduction. And she knows every year that trust is going to pay her this amount of money, probably quarterly, and it will never change. It will not go up. It will not go down. And at the end of her lifetime, whatever remains in the trust, that's what the word remainder is, whatever remains that hasn't been spent down is allocated and paid to the charity or charities she names in the trust agreement. If she chooses the charity to be the trustee of this trust at the beginning, then the charity anticipates an irrevocable remainder interest. If she becomes her own trustee or has a trust company or an advisor become trustee, she can change charity. She can decide what charity she wants and make some alterations. But most people don't want to be bothered with the administration of the charitable remainder trust. They usually either use a trust company or they ask a charity. And by the way, if a charity is requested to be trustee, it cannot charge a trustee's commission or any other fees because it is a charitable vehicle that they have an interest in at the very end. This is called a charitable remainder annuity trust. A rate is fixed based upon age. Things never change. Payments are made exactly as we determined in year one. But for those individuals who look at a trust and hope for some adjustment based upon inflation, we have what is called a charitable remainder uni trust. And a uni trust does the same thing, fixes a rate, and makes payments to this individual for a lifetime. However, this rate, although fixed, in my example, 7%, is the rate that's multiplied against the value of the trust at the end of every year to determine next year's payment. So if the trust has $500,000 in value and it grows to be worth $550,000 at the close of the year, next year's payments are 7% times 550. So you're keeping pace with inflation and sharing with the growth. The downside, of course, is there may be a year where the assets lose some value. I mean, it's going to be invested reasonably conservatively in a mix of stocks and bonds, but there are market times when there's going to be a flat year or maybe a bit of a lost year. So the next year's payments may be lower than the current year's payments. But then when it goes up the following year, your payments go up again. So people who have some tolerance for risk will choose a unit trust because A, the rate can be higher than an annuity trust. And number two, you share in the growth by getting this multiplier against the revaluation at the close of every year. Usually, any gifts of real estate, works of art, things that we call illiquid assets are used in a charitable remainder unit trust because it may take some time to sell the assets. And during the time it takes to sell the assets, we accumulate an obligation to pay you when the assets are sold, that which we couldn't pay you up to that point. And under good planning scenarios, you'll get the makeup, we call it, of what you weren't paid, and then go forward to receive regular payments when the trust is more liquid. Both these examples, although set up in my examples here for older individuals individually who aren't IRA owners, I'm saying that if you have beneficiaries who are 50, 55, 60 in either example, your rates will be impacted somewhat, but you can pay them for life or lives. As each one dies, the others or the family members of the one who died get paid until the trust is over. This is what you're going to see more and more discussions about with regard to IRAs, 401ks. The planning that used to be routine is no longer routine. It's much more complex. And lastly, let's just take a quick look at Yad Sarah's rates if you decided to contact Adele to know more. And by the way, it's always valuable in confidence to make a contact with Adele. She would get the confidential calculations for you. You have no obligation to do it. You don't have to tell any more than dates of birth. And you might find the calculations to be compelling and it might decide upon doing it, but you don't have to. The point is, though, what you find out may be useful in doing your overall planning as you talk to your tax and financial planners. Rates, age 70, 6.5. 75, 7.1, 80, 8.0, 85, 9.5, and 90, 11.3. You can see, depending what age you are, how much is tax-free. And by the way, you can see, even at age 70, it's nearly 85% tax-free, and it grows to almost 90% tax-free at age 90. So in essence, you've got a scenario here which can be very valuable for you in your planning. So just to close, be aware of, be alert to tax law changes, both income tax law changes and estate and gift tax law changes that will be proposed in 2021. Be alert to the fact that a lot of the things in the CARES Act, like the AGI rule for 100%, will not exist in 2021. It may be that the $300 rule that gives you that much deduction if you take the standard for charitable giving will be, well, we don't know for sure. So be alert to the fact that what we had for 2020, that is the fact that you don't have to take your RMD in 2020 will not apply to 2021 unless things change and it gets reenacted. Hard to
Okay,
imagine.
we have a question from the floor.
Okay.
If you have multiple IRAs with different custodians, are you required to fill out a form with the custodians whose IRAs you are not taking RMD from, so they know you're taking from another IRA? Some banks require this type of form.
Yeah, well, probably because your administrators are going to remind you that you're required to take your RMDs. You can take all your RMDs, all of them, from one IRA, but you're going to have a dialogue. Some administrators, for example, will routinely send you your RMD. I know that Fidelity, if you have money at Fidelity and it's a qualified plan money, they will prepare themselves to send you in November, December, your RMD from that account. You can avoid that if you want by simply saying, I'm going to take my total RMDs from other sources, but the IRS will know whether you've taken appropriate RMDs, and you don't have to take them all from the same account.
I don't know if you mentioned, or it might be worthwhile just mentioning that funding gift annuities with qualified plan funds may not be the most advantaged way of proceeding.
Yeah, we should mention, yes, again, because of the RMD moratorium in 2020, the fact that you could make charitable gifts from an IRA under the charitable gift annuity rollover provision. We didn't even apply that in 2020 because people weren't doing it, but going back to 2021, you can make gifts from your IRA directly to charity of all or a portion of your RMD. And to the extent that they're charitable gifts, you pay no tax on the RMD. It's a tax qualified charitable distribution. But that's an outright gift to charity, not to a donor advised fund, not for a charitable gift annuity, not for a private foundation. So that's got to be an outright gift to charity to avoid tax on an IRA withdrawal that is part of your RMD if you make it for charity. If you make a withdrawal from your IRA to create a charitable gift annuity, you will have realized a taxable event by taking money out of your IRA, and you'll be charged income tax on that withdrawal like you would for any RMD withdrawal. However, you will get an income tax charitable deduction for a portion of the money going into the gift annuity from the IRA, and that will reduce the taxes somewhat. Two different scenarios. IRA, the charitable gift annuity, taxable event. IRA directly to charity, not a taxable event, up to $100,000 in distributions, beginning in 2021 and going further. It would be wonderful for those of us who would like to not have to take RMDs, that they would renew the RMD rule for 2021 that will make another year's worth of moratoriums. But I don't see that happening, unfortunately.
Are there any other questions?
Let me close by saying that please let us know, Adele or me. You can see my contact information at the beginning and we will send it to you. We'll send you a link so you can listen to this or read this material. And we're free and available to you in confidence to talk about your planning. We will let you know from time to time about the things that change. And of course, Yad Sarah is grateful for all of you for making it possible for the work in Israel to be carried on to benefit people who are poor and needy, who otherwise would have no place to go to get help, but for Yad Sarah. So Adele, I'll turn it to you for some closing remarks.
Thank you, Neal, for this very informative and interesting presentation, which can benefit our donors and can greatly benefit the organization as well. We appreciate your participation and your interest. And as Neal said, feel free to be in touch with me directly, either via email or by phone, to discuss any questions that you may have or concerns, with absolutely no obligation to proceed. We appreciate your past support of the organization, and we want to take this opportunity to wish you all a happy, a healthy, and a safe 2021.
Thank you, everybody. Good to see you all. Take care.